Good morning, everyone. Thank you all so much for joining us here today. We have a really exciting presentation, very special presentation for you all here today. Shahar is awesome at this. But before we get into it, and as people kind of come in, I just want to do a little intro. Thank you all for coming. We're going to be in webinar mode today. I'm sure you're all used to Zoom at this point, but what that specifically means is that you're all automatically muted and your cameras are off. So feel free to enjoy a late breakfast, early lunch, have a snack, sit back and enjoy. This also means that we're going to be using the Q&A feature today for questions rather than the Zoom chat. If you can't find the Q&A feature on your taskbar, sometimes it's minimized. So you would want to hit the circle with the three dots that says more on the Zoom taskbar. And then when it pops up there, you should see something that says Q&A. So we do encourage questions. Feel free to pop any questions in the Q&A there. We're going to try to keep those organized and be able to filter those into Shahar as they come or towards the end, depending on what works best for timing. And thank you all for joining. This webinar is also going to be recorded, so you're going to be able to reference it later on as well on our YouTube, as well as we're going to send that link in a follow-up. So that is going to be really great. If you feel like you missed anything, there's going to be a lot of information. You can always reference it again as a follow-up. So I do want to also mention really briefly about the credit union before we get started, because one of the main questions we always get is, what is a credit union? Why is it different from a bank? What does that mean? So Harvard Federal Credit Union, we're a credit union. Credit unions are not-for-profit financial organizations. So basically what that means is that we do everything a bank does, is except that we are not-for-profit. So the profits that we do accumulate as being a financial institution, we are able to reinvest into our community, into our membership in a lot of different ways. We are able to waive a lot of different types of fees that other banks might charge. We generally have better rates for a lot of our products, both savings as well as loans. And we are very community focused. We're not very salesy. We are always just trying to help people. That's why we do these types of workshops and everything. But you're all here for investing advice, which is awesome. We actually even have an investment advisor that we're going to try to introduce to you at the end of today's presentation. But before we get to that, we're going to hear from Shahar, and he's going to teach us all about it. So Shahar, thank you so much for being here.
Awesome. Thanks so much. Hi, everyone. Excited to be here. Today, we're going to spend about 60 minutes talking about a guide to investing. And I'll give you a little bit of background on myself as we go through. But just to start, a little bit of disclaimer, just so you know, this is mainly for informational purposes, educational purposes. This is meant for that as opposed to specific type of advice. And so obviously this is meant as a starting point for you, but you have to kind of do your own calculations in terms of merits and risks of any type of investing that you take on. So look, I know in school, oftentimes you kind of work your way up to the answer. I'm going to start and just give you the secret to building sustainable wealth. You ready? Be average. Now, that's probably the most counterintuitive thing that you've heard today, this week, and probably maybe during your entire life, because being average is not how you got to Harvard. You've strived to be exceptional, above average, among the best. But the reality is that when it comes to investing, aiming for average gets you above average results. Now, that's easy to say, but let me start to kind of build the case and prove that to you. So some of you may know who this person is. It's Warren Buffett, the legendary, kind of founder and until recently the head of Berkshire Hathaway, one of the most legendary investors of all time. Warren Buffett's advice for 99.9% of the population is essentially what I said, be average. And what he means by that is don't try to beat the stock market. Basically, try to just be the stock market and try to track it. And he was so confident in this that he put up $1 million against any counterparty, and a hedge fund named Protege Partners took him on, that his average investment, which was essentially in tracking the S&P 500, which is kind of a part of the stock market, would outperform whatever the hedge fund wanted to invest in. Now, it was a win-win. The money went to charity, but the results were not even close. Warren Buffett's average investment returned 125%. Protege invested in 5 different, hedge funds. They returned 22%. Average returned 6 times chasing what it was basically by chasing, the extraordinary, if you will. Now, this is not an anomaly. If you look here, this is from JP Morgan. It's a 20-year view of returns. You can see on the left in the kind of red, highlight, that's the S&P 500. Again, just an average investment returned 9.5%. And you can see how, somebody who invested and didn't necessarily follow that made a lot less. And there's a lot of academic literature also showing that people who try to trade more actually end up doing worse than those who simply invest and leave money in the market. So again, if you have to leave right now, if anything, the main message I want to give, kind of impart to you, is aim for average. You will be very happy with how you're doing in the long run. Now, let me just back up a little bit and kind of say, who am I and essentially why should you be listening to me? So I started this program back in 2010. I can't believe it's now about 16 years. And I've come back every single year to teach it. I'm extremely passionate about this topic. I work with a lot of other universities, employers, organizations, and do this in many other capacities. I love to teach it. I love to write about it. I love to speak about it. Most importantly, though, is at the bottom. I am as objective as you're going to find on this topic. I'm not affiliated with an investment management firm. I'm not trying to solicit you to manage your money. Any product or company that I'm talking about, I don't get any type of compensation from them. In short, I don't have any conflicts of interest. And I'm very proud of that. But it's also essentially my first lesson to you, or maybe second, when it comes to investing, which is you always need to ask yourself, why should I be listening to this person? Are there any conflicts of person or any reason why they're not being fully objective in terms of the guidance that they're giving me? We'll come back to that a little bit towards the end. Now, look, I talked about Warren Buffett. On the right is Melody Hobson. She's one of the other kind of amazing investors out there. She's the CEO of Ariel Investments. Fun trivia fact, she's also married to George Lucas of Star Wars fame. In our 60 minutes today, I can't turn you into all of them. This is really about breadth more than it is about depth. We're going to talk about, the basics of creating an investing portfolio and some high level guidance. We can spend an entire semester and frankly an entire year talking about the kind of minutia of this. But this is really about giving you some very practical insights and strategies for how to start to think about investing. So let me kind of start, very foundationally, and we'll kind of work our way towards some very specific guidance. So look, the reason to invest is that the stock market has traditionally outperformed and has been the one to return the most amount of money in the long run. You can see that compared to bonds or kind of any other instrument, overall, the returns from the last 100 years, if you will, have been about 8% year over year. And so if you had invested $100,000 20 years ago, for example, you would have $370,000. If you had invested that in something much more conservative like bonds, you would not necessarily have made as much. So not only is investing important because it helps you to generate wealth, it also helps you to overcome inflation and other kind of factors as well. So the other reason that is important is it's really a way for you to build long-term wealth. And let me use an illustrative example of this, and then we'll kind of dive in. So imagine you're walking down, Harvard Yard, and you see a penny on the ground. It's not a regular penny, though. It's a magical penny. And it's magical because it doubles in value every single day. So on day 2, you have 2 cents, then 4 cents, 8 cents, 16 cents. Any guesses as to how much money you have on day 31? Feel free. Anything you put in the Q&A is anonymous. I will not read out names. Feel free to take any guesses. So the answer may surprise you. $10.7 million. Now, imagine, the first day you were too distracted doing something on social media or on the phone, and you only picked up the penny on day 2. How much money would you have at the end of that same 31-day time period? The answer, half, call it $4 million. And if you only picked up the penny on day 10, you'd have $21,000. Now, don't get me wrong, $21,000, a lot of money, I'd happily take it, but I'd much rather have $5 or $10 million. So what's happening here? Well, a couple things. One, going back to my point on objectivity, anybody who promises to double your money every single day, or frankly, every single year, I would take with a heap and a mountain of salt because that is not something that can be done legally over, the long run. But what I'm trying to illustrate here is what you see on the top of the slide, which is the time value of money, and the essentially what's known as the kind of power of compound interest, which is money starts to kind of snowball and build on itself exponentially over time. Now, look what's happening, and let's focus in on the green starting day one column. When you're going from day, in absolute dollar amounts, even though the money's doubling in absolute dollar amounts, at the beginning, it's not much, right? When you go from day 4 to 5, you're getting 8 cents. Going from day 10 to 11, doubling means, a little over $5. But when you get down towards day 29 and 30, doubling means $2.5 million, $5 million. Those are the doublings that really matter. The key insight is that in order to get to those doublings and give yourself the opportunity for those large doublings to happen, you have to start early. The earlier you start, the more time you have for your money to grow, compound on itself, and essentially double. And you can see that in this case, even one day gives your money the opportunity to double one more time and go from 5 to $10 million. In short, compound interest is a superpower that every single one of us should take advantage, and that's critical when it comes to investing. Now, if I zoom out from pennies and days to something a bit more, realistic, which is, dollars and years, you can see the impact that this can have. So imagine that you invested $10,000 a year for 40 years, and on average, you made 7% each year. You would have put in $400,000 over that time, and your portfolio balance would be about $2 million. Now, I'm going to show you two different graphs, which hopefully you'll find as insightful as I do. The first is, the percentage of your final portfolio by the time that the money went in. And perhaps it should come as no surprise that the money that you put in year one is a much bigger percentage of your portfolio than the money that you put in the last year. That money has had a lot more time to grow and compound. But here's the really interesting chart. Over half of your final amount, over $1 million, is actually built in the first 10 years of saving. So even though you're saving for 40 years, over half of that portfolio you actually generate in the first 10 years. And that's again due to the compounding and starting early. So when it comes to investing, we'll talk about some specific ideas of how and where to invest, but I do want to impart the kind of broad concept, which is time is your most valuable asset. When you are 18, 19, 20 in your early 20s, the earlier and the more consistently you can start saving, the more likely you are to position yourself as starting on day 1 or 2 of that penny example, and you're giving your money more time to work. Here's something that's hopefully resonates a little bit more. This is just the power of investing in your 20s. So let's take 3 individuals. All of them are contributing $200 a month, earning 9% each year. But one person started in their early 20s, one in their mid 20s, and one in their late 20s. So yes, they've invested, a few more years, and maybe it's a couple extra $1,000, but you can see the difference that time has in terms of the overall amount. You go from 700,000, an extra 4 years gets you an extra 300,000. It makes a huge difference just by starting early. So just to kind of foundationally, make sure that you are, kind of starting to contribute as, early as possible, and putting your money to work as quickly as possible. So let's get into kind of some of the nuts and bolts of investing. And we'll go through a couple different things around, key terms, how to think about timing, risk, how do you align things with goals, and then I'll give you some specific thoughts around building a portfolio. And we'll end talking a little bit about whether you should be doing this alone or getting help and how to think about that. So I'm not going to necessarily drain these, but there are some different terms that I think are important to know. So, checking and savings account, a lot of you put your money in. up to pretty high amounts. It's guaranteed, and the way you make money on it is a bank or a credit union will usually give you some interest on the money that you have in there. If you go down bonds, which I referenced before, bonds are essentially an IOU from a company or a government. So they'll issue bonds in order to raise money, and bonds essentially promise whoever holds it to get their money back plus some interest at the end of a specified amount of time. Now, whereas a bond is an IOU, a stock, or otherwise referred to as an equity, actually means you own a piece of a company. And so if you own, one share of Apple, you actually own a tiny, very, very, very tiny piece of Apple. And the way you make money is if Apple does well, the price of that, share will go up. And also some companies give out yearly or quarterly payments to shareholders, which are known as dividends. Now, there's different ways of bundling bonds and stocks together. And one of the most common and important ones, which I talked about in terms of the Warren Buffett example, was an index fund. And an index fund is essentially a basket of stocks that is meant to just track a portfolio that's in the market. For example, kind of the top 100 companies in a specific, index or something like that. It's not meant to beat or try to beat that index. It's really just meant to track it. And something that's a lot more common now are called ETFs, which similarly are also kind of a basket of, stocks or bonds. But unlike mutual funds, they can actually be traded at any time. And this notion of, ETFs versus mutual funds, that's coming up to the forefront of kind of discourse a lot more these days. And so I wanted to just put together a quick slide about the differences between the two. You can see that there's a difference in terms of when they're traded, the fees, tax efficiency, and whether you can kind of automate investing, if you will. In short, if you're looking for lower expenses, tax efficiency, and some more flexibility, ETFs are a good option. Mutual funds allow you to automatically invest, which reduces temptation. And it's really good for accounts that have some sort of tax advantage. Both of these can be an important part of how you think about investing. I will focus later on more on ETFs, just because I think for college students who may not have a ton of money to put away, ETFs can be a really good way to enter the market without having to make a minimum investment. So when you think about investing and building an investment portfolio, there's a lot of different dimensions that you can think about. And most importantly, I think, is the mix of different asset classes, stocks, bonds, et cetera, that you put into your portfolio. The second is the type of, let's say, ETF or, mutual fund that you have. Passive mutual funds are essentially index funds. They're passive because they're not trying to trade in and out and trying to outperform. They're just trying to track the market. An active fund, it has, humans in most cases who are actively, researching companies and trading and buying and selling in the hopes of outperforming an index. And we'll come back at the end to show you a little bit about how often they're able to do that. Some other dimensions that you may want to think about: how much of your portfolio is invested in domestic, kind of stocks, US versus international. How much are you investing in small type of companies known as small cap versus mid or large cap companies? When people say cap, what they're talking about is capitalization. It's essentially when you take all the number of shares that a company has issued multiplied by its stock price, that gives you its market capitalization, which is how much essentially that company is worth. So there are different ETFs that will focus on small cap companies, some that focus on large, etc. And finally, there's a lot of different individual characteristics of funds to look at. But these are, in order of importance, in my opinion, how I would think about factors when building a portfolio. Now, how do you start thinking about investing and what to kind of invest in? Well, what I would say is that you want to start by thinking about why you're investing. And by that, I mean, you need to identify the goals that you're investing for. And, I think of a lot of different types of goals. You can have savings goals, like I want to, save for a down payment for a house. I want to save for grad school. It can be about debt payoff. Maybe you have some student loans that you're paying off, or it can be about impact, impacting, family, broader community, personal impact in terms of, taking vacations. It's important to identify why it is that you're saving. And the reason for that is that those goals will help establish how much time you have for that money to work and essentially invest. And I'll show you why that matters. For each of these, it's important to identify the time horizon and how much money you're looking for. Now, the reason that's important is that you can have a lot of different options, again, in terms of what you're investing in. And depending on how long your time horizon is, you may want to take on less or more risk. So here you see some different categories of, things that you can invest in. The S&P 500 is just a big index that you can invest in. We talked about small companies, there's real estate, gold, and you can see, the 1 year, 5 year, 10, 20, et cetera, year performance. So essentially, once you understand how much time you have, you can decide how much risk you can take on, and that will drive the investment options that you have. And the basic principle is that you want to align your risk and how much risk you're taking on with the time horizon you have. The longer the time horizon that you're saving for, the more risk you should take with your portfolio. The shorter the time horizon, the less risk you should take. So, for example, if you are a junior and you're thinking of going to grad school right after finish college, you have maybe a 1 or 2 year time horizon. That I would not necessarily advocate throwing 100% of your money into kind of an investment portfolio of stocks or mutual funds. And I would actually focus on less risky, places to put your money. But if you're saving for retirement, let's say, or the next generation, something in 30 or 40 years, you can and should take on more risk with your portfolio and actually skew it very heavily towards stock-based mutual funds. Let me explain why that is. So, if you had invested $1,000 in stocks and you looked at what could happen over the course of 1 year, and you looked essentially over the past, call it 100 years, the best year you would have made 50% returns. You would have $500. But in the worst year, you would have lost a third of your money. And so if you need that money in 1 year, I'm not sure if you necessarily want to roll the dice on this, because if you need a certain amount of money, you could actually lose a third of it. But look what happens over a longer time horizon. That same $1,000, if you had invested it and then you looked at every 20-year time period, so let's say 1950 to 1970, 1955 to 1975, you looked at all of those 20-year time periods. The best, you would have made 18% every single year. The worst, 6% every single year. Now, obviously, 18 is better, but 6 is not too bad. Not only is it positive, but you can see that the kind of delta is starting to shrink between these. This is that same chart or same data represented in a more graphical way. And I would focus in on the green bars. So you can see how the 1 year and the 20-year figures align there. You see the 52 and negative 37. So two things happen. The difference between the best outcome and the worst outcome starts to shrink. Over a 1 year time frame, there's, what is it, an 89% percentage point difference between best and worst outcome. But when you look at a 20-year difference, the difference is a lot smaller. It's a 12 percentage point difference, right? And you can see that the worst outcome starts to look a lot more positive. So the longer the time horizon you have, the more you can afford to ride out short-term volatility and essentially trust that over the long run, the stock market and stocks will outperform and you will essentially earn a good and positive return on your money. Okay. Now, in terms of looking at stocks versus bonds, a couple of things to know. Stocks have always outperformed in the long run, but bonds are a bit more conservative and help you to reduce risk. And so the rule of thumb is the longer the time horizon, the more you want to be skewed towards stock and stock-based mutual funds. The closer you are to needing your money, you want to be a bit more conservative. So one approach is if you take your age and subtract it from 110 or 120, that gives you the percentage of the portfolio to keep in stocks, and the rest would be in bonds. And you can see that if you're 20 years old, that could very much mean that if you are saving for the long run, let's say for retirement, you should have and start out with a portfolio that is solely invested in stock-based mutual funds or ETFs, or 90% plus. You have that much time to ride out any of that volatility. Oops, let me go back there. Okay. This is a view of essentially how that would play out as your time horizon starts to shrink. And let's say you're saving for, a long-term goal like retirement. On the left, you can see, let's say when you have 40 years until retirement, you can see that, the majority of the money is based in stock-based funds. But as you get closer to needing that money, you should probably reallocate your portfolio and have a bigger portion in bond-based mutual funds. There are specific types of mutual funds out there called target date funds, which essentially automatically rebalance your portfolio as you get closer to retirement. And so a target date fund is a one-stop shop, a set it and forget it type of fund where you just have to say, okay, here's the year that I'm thinking of retiring, 2065, 2070, and it will then allocate based on, kind of that notion of the longer the time horizon, the more risk. And as you get closer, it should be less risk. Now, look, there's a lot of hype out there, whether it's on social media or in the headlines around, crypto, kind of meme stocks, all these different very complex instruments like derivatives, zero-day options, things that you'll find on Robinhood. My recommendation for you is try to ignore the noise and focus in on the signal. And the signal is be average and be a boring investor. Investing in an index fund and, kind of the Warren Buffett approach of average is not glamorous. It's not something that, you write about all the time, but it works and it works in the long run very, very successfully. If you had looked at probably the most common index fund out there, which is the S&P 500, if you look at the annual return over the past 50 years, it's been about 8.5% and over 11% if you include dividends that have been reinvested. That's pretty good return to make every single year on average. And here's the thing about this 50-year time period. This incorporates seven what are called bear markets, which are really big drops in the stock market, including the 2008 crash, where the S&P 500 and the whole market fell by over half. And it includes the early kind of bear market in 2022. So even given those huge crashes, you are generating 8.5 or 11% annualized returns just by being boring, quote unquote, and investing in a very simple, low cost index fund. Now, the other option you have is essentially what's known as an actively managed fund. And as I mentioned, this is where companies will hire a portfolio manager or a team of portfolio managers whose goal is to try to beat the market. And they'll do this by, doing a lot of research, going to conferences, like talking to people at different companies, and basically trying to, predict which companies are going to do well and which, in other words, which companies they should buy stocks of and which ones are not going to do well and which ones they should sell. Now, if you look at the data, and this is something that happens every single year and is published by the S&P, they publish a report looking at what percent of active stock managers actually beat the market. Now, in one year, 28% beat the market. Over a 5-year time frame, similar. Now, still, let's pause there and just say, even in a 1 year time frame, 72% are lagging the market, are not able to beat it. Now, as you get into longer time frames, the numbers really, really drop. Over a 20-year time frame, only 7% of active stock managers were able to actually beat the market. 93% failed to beat the market. So yes, if you could predict who those 7% are, you could have done a little bit better. But overall, actively managed funds, it is very, very hard to actually beat the market. And you have, firms and companies and individuals who dedicate their entire, professional lives to doing this. And you can see the data, 7% over a 20-year time frame. So essentially, if you focus on passive index funds, you're going to do pretty well, and in most cases, based on that data, better than even thinking about other ones. The other benefit of investing in passive funds is that they have much lower fees. Because they're simply trying to track the market, there's not much going on there, and companies can pass along, those lower operational costs to you. Actively managed funds, you have to pay for the portfolio manager. There's a lot of trading involved. Those tend to cost more. There's a company that rates mutual funds. It's called Morningstar. And they did a lot of research and they found that the fund fees are actually a better predictor than even their star ratings. And you can see the quote there, which is in every single time period and data point, low cost funds beat high cost funds. So index funds and passive funds are good in general. They're also one of the reasons is because their fees are significantly lower. Um, this is just as backup. I'm not going to drain this, but a little bit more of their analysis to kind of back some of this up. Now, look, I've tried to maybe make the case with data, with anecdotes on Warren Buffett, with some different stories and some theory. If none of that has resonated, let me try with one last technique, which is humor.
Interest works both ways, meaning while your money adds up, your fees can really add up too. Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. You've lost almost 2/3 of what you would have had. 2/3 of what you would have had is gone. So think of fees like termites. They're tiny, they're barely noticeable, and they can eat away your future. And one place where your 401k can be full of termites is the funds themselves. Generally speaking, you can choose between low-fee index funds, which basically just try to match the average returns of the stock market, or for a higher fee, you can get an actively managed fund with experts who will pick and choose stocks for you, trying to beat the market. But the problem with active management is that even many Wall Street experts find it difficult to consistently beat the market. And there is sometimes embarrassing evidence of this, like when a group of professionals were pitted in a stock-picking challenge against a cat named Orlando. Orlando's method, he throws a toy mouse at a grid of companies. It's very scientific. Last year, Orlando's picks returned nearly 11%, while the pros engaged just 3.5%.
All right. So, oops, let me just jump to, there we go. So, lots of different, kind of maybe ways of communicating the same point, but there's a lot of consistency in the data out there. Now, I want to cover quickly at least some of the other dimensions, and then we'll get into some specifics. I talked about kind of US versus international, and the reality is that, at least according to Vanguard, which is one of the biggest investment management companies out there, they did some research that showed that on average, US investors actually don't have a lot of or sufficient exposure to international stocks. Now, I won't bother you or kind of concern you with the minutia of that, but the headline that they came up with is that 20 to 40% of your portfolio should be allocated to international, securities, if you will. 20% is a minimum, 40 is probably the upper range. There's different ways of, investing in international companies. I'll give you just probably the biggest split, which is you can invest in just, developed markets or emerging markets. Emerging markets, as you might imagine, carry a little bit more risk and therefore have more volatility, but potentially some higher returns. Investing in very developed markets like UK, France, Japan, etc., probably a bit more stable. Obviously, may have lower upside as well. Now, there are a lot of different ways that you can invest. And other than the kind of first line, first or second line there, if you will, around, a checking account or, call it a high yield savings account, all the rest of these are different investing accounts that you can open and have different purposes. And I know we're not going to go into too much detail here, but I do want to just run through some of these so you understand the basic role of each of these. And then I'll talk a little bit about some examples. So we talked a lot about retirement. And again, the reason is the earlier you start, the easier it is to set yourself up for, really big, kind of wealth. There's two ways to save for retirement, what I call employer-sponsored savings or individual savings. So for any of you who go and work at a company or even for, kind of a public sector company or the government, um, most of those companies will sponsor a retirement plan. That can be in the form of a 401k, it could be a Roth 401k, and essentially those companies will work with an external investment management company to administer that retirement plan and make available different funds. Some of those administrative companies can be Fidelity, Vanguard, Charles Schwab, etc. When it comes to retirement savings and employer-sponsored accounts, this is a really good way to invest for retirement. And partly it's because these accounts are tax advantaged. So the government wants to incentivize each of us to save for retirement. And so it gives different tax advantages to different types of accounts. A 401k, for example, is known as a pre-tax account. Basically, you put money into it and you don't have to pay taxes on the money that you put in. That those taxes get deferred. You invest the money, it grows, and then in retirement, when you take the money out, that's when you pay taxes. An account that has the word Roth in front of it has a different type of tax advantage. It's a post-tax account. So you put money into that account after you've paid taxes, but then it's miraculous because it grows tax-free. And when you take it out in retirement, you don't pay any taxes on it whatsoever. And so there's different types of advantages. In general, Roth accounts are really good when you're early in your career and you're not making a lot and therefore paying lower taxes and you're in a lower tax bracket. And because you're essentially paying less for every dollar that you put in. When you reach your peak earning years, a 401k also could make more sense because essentially you're deferring paying taxes when you're, kind of in a really, really high tax bracket. Now, you don't need to wait until you start work in order to save for retirement because there's also different accounts that you can open by yourself, and you can actually open those almost at any point. These are called the main form is called an IRA, individual retirement account. And similarly, there's, a regular version, which is pre-tax, and a Roth version of that. For all of you, I would argue that right now or your first couple years after graduation, a Roth account is a tremendously positive way to save because right now you may not even be paying any taxes or you'll be at a very low tax rate. So every dollar that you put in, you essentially would almost pay, very little or no tax and then would grow tax free. The one wrinkle, just to know on a Roth IRA, you have to have earned income in a given year in order to contribute. So, if you're doing some work at the university, working a job on the side, et cetera, as long as you have earned income, you can contribute up to that amount to a Roth IRA. There are a couple other accounts that you can open up. A health savings account is usually coupled with a health plan, and this will usually come in when you're working. And it allows you to put money away for medical expenses tax-free. There is something called a health savings account, which is tied to a specific type of health plan. It's called a high deductible health plan. And instead of just, using that money to reimburse yourself for medical expenses, you can actually invest that money for the long run. And a health savings account is one of the most powerful investing accounts out there because it has the benefits of both a pre and a post-tax, kind of tax advantage. In other words, the money that you put in isn't taxed. It grows tax-free. And when you withdraw it, as long as it's withdrawn for qualifying medical expenses, it's withdrawn tax-free. So there are three different types of tax advantages out there. When it comes to saving for education or, just what I call starting to establish generational wealth, you can look at accounts like a 529 account or different custodial accounts for, minors. All of these are places that you can invest in. And then finally, there's what I call a brokerage account, which is a taxable investing account, which is what many of you may be thinking of if you're opening, going to, kind of a Robinhood or Charles Schwab and opening up an account. That's a longer term investing account, and there's essentially, often no tax advantage to that. Now, you see on, let me just see if there's a question that came in. I'll address this in a second. Now you see on the right, I just gave a few illustrative examples of, different places where you can open up some of these accounts. There are many, many other options for these. I don't mean to, just steer you just to these. The reason I put some of these, and you'll see these recurring in future slides, Fidelity, Vanguard, and Schwab, these are very large, reputationally, kind of, solid investment management companies that have a lot of low fee index fund options. And so going back to everything we've talked about, I think that's extremely important when you're thinking. There are many other companies that also have that, but I'll kind of focusing in on a few of those there. A question came in around when is it recommended to begin investing? Could and should people start as early as college? So if you go back to kind of what I was focusing on at the start, I think even as early as college is really important and a really great time to start. Now, look, I know when you're in college, you're many of you or most of you are probably not working full time. You may not have too much of an income, but I do think it's important to start with any money that you have, whether summer internships. If you can start to put a little bit of money aside and invest even as early as now, I think you'll see that you're giving your money even more time to grow. At the very least, I would say that, once you graduate and once you start working full time, that's when you really want to start to kind of ramp up your investing. Now, leads to another great question which came in, which is how do you know whether it's better to invest your money or focus on paying off debt? That's a great question. So look, on average, in the long run, the stock market has returned about 8% annually when you look at, kind of on average. One of the best ways to look at whether it's better to invest or focus on paying off debt is to look at the interest rate on your debt. So let's say whether it's student loans or, mortgage, car loan, whatever it is. If your debt is at 3%, I would argue you're going to be much better off investing your money in the long run. If you have credit card debt at 15 or 20%, you are going to do much better by paying that off before you start to invest. So that's probably one of the biggest variables is to look at, what is the interest rate on the debt you're paying off. There are some other behavioral, kind of aspects, but if you have a significant amount of debt, the most important thing is to say, what kind of debt is it? What is the interest rate? Are there any opportunities to lower that interest rate? And kind of how to think about that. How can international students invest in the US? I think that's a great question. So often you'll need to do a couple things. One, you'll either need to get an ITIN, which is just an international, an individual tax identification number. Or if you've been here long enough and you qualify, you can get a social security number. You then need to find a different kind of investment management companies that some of them will allow you to open up accounts with, different levels of, customer information. Some may require you to be a US citizen, but there are some out there, and I'm happy, to kind of chat offline, where you should be able to actually make investments, without necessarily having just a social security number. And so it's a matter of finding, institutions that are willing to let you open up accounts with the documentation that you have. And then the follow-up, do you have suggestions of specific investment companies that international students can use if we do have an SSN? Yeah. So look, I would kind of steer you towards the ones that I put here on the right, kind of a Fidelity, Vanguard, Schwab, some of those. I think if you have a social security number, you should be able to open up, with at least some of those. And I think those would be some very good options. All great questions. So look, I can't give you specific advice on, say, invest in this specific mutual fund or in this specific ETF. What I want to do is just give you kind of a grounding of, that's, not just theoretical, but also, not a specific one to invest in. And so I wanted to give you just different illustrative categories of, ETFs that exist. So there are ones that invest in the entire US market. And as I mentioned, I'll give you, according to each of these different, companies that you might be able to choose: Vanguard, Schwab, Fidelity. Each ETF has, a ticker, if you will. It's a 3 or 4 letter kind of symbol. And so if you wanted to invest in the Vanguard ETF, that's for the entire US, you would go to Vanguard, you would put money in, open up an account, and you would search for VTI. Now, going back to what I talked about before, which is the expense ratio, or kind of the fees that an ETF or mutual fund charge are known as an expense ratio. And as I talked about before, ideally you look for ones that have very low fees or very low expense ratios. And you can see that, let's just focus in on that all US line. Any of these have extremely low fees. They're called kind of 3 basis points, if you will, for any of those all ones, or kind of 0.3 of a percent or 0.03 of a percent. Very, very low. Now, as I showed you kind of that step ladder before, if you wanted to just invest in the S&P 500, you have options for that. If you wanted to invest globally, you have some tickers for that. In this case, Schwab doesn't have a specific ETF for that. If you wanted to say, okay, well, I already invested in the US, I want to invest international without the US, you have options for that. And then there's different, you can really kind of start cutting this in different ways, focusing on companies that are, kind of predicted to grow much quicker. We talked about small and mid cap a little bit before, and also different sector specific ETFs. I put tech there just because that's in the news quite a bit now. There's also, defense, cyber, whatever it is that you want to look at. So these are all kind of different categories. Again, this is illustrative. There are many different options. I put together, one option for what I call a starter ETF portfolio. And you can see that these kind of track a little bit of what we did before. And again, this all depends on what your goals are, what your time horizons are, etc. But this is assuming that you're looking at something that's, long term. So here I said, okay, one option would be, why don't you put 40% into VOO? And all these will be, kind of the ones that you saw previously, which is essentially giving you long-term growth and saying, okay, I want to own a piece of the US economy. We talked a little bit about the Vanguard research showing that you should have 20 to 40%, exposure internationally. So VXUS is looking at international without the US. This gives you some diversification and adds some global balance to your portfolio. QQQ is is a kind of a tech ETF. It's focused on growth and high growth upside. It looks at the NASDAQ 100, which has a lot of tech companies and innovation. So here it's saying, okay, I'm going to put a little bit of a bet for the long term on that mutual fund. And then to kind of smooth out a little bit, there's kind of SCHD, which is the Schwab kind of dividend kind of ETF. And this is focused a little bit on cash flow and providing passive income, and 5% in kind of a bond fund to smooth out volatility. Again, one example of many. Depending on your goal, your risk tolerance and time horizon, you can come up with different types of portfolios. And again, these are all illustrative and just kind of, the first one is the one we just went through. If you want something that's even simpler and you have, kind of low risk tolerance, you can actually do it with 2 different funds. There's a lot of different, ways of looking at this. You can see, for example, when you get into, kind of retirement prep and you have a much shorter time horizon, you can see that there's a little bit of a shift there in kind of the ETFs that are in that portfolio, focused a little bit more on conservative type ones. Finally, if you really have a high risk tolerance and a high time horizon, you could really ramp up your exposure to tech or whatever it is, and kind of place much bigger bets. What I want to emphasize though is there is no right answer. These are all, well reputable individuals or institutions that have put together their view of kind of a portfolio. And you can see that they differ in terms of, the allocation, the number of, investments that they look at, and obviously what they're actually looking at. And there is no right answer. It all depends on, kind of your goals, your risk tolerance, your time horizon, and several kind of other factors within there. But important to emphasize, those pieces. Now, one thing I do want to emphasize, you've probably heard the expression, don't put all your eggs in one basket. It is important, and you've seen from even, what I put up here, that these are pretty well diversified. And the fact, obviously, these are all, mutual funds or ETFs, which are, bundles of different instruments. There's no single stock in here. What I want to also emphasize, though, is that when you're focusing on diversification, more funds does not equal more diversification. So as an example, you can see here in this graphic what it is that you're buying when you invest in specific ETFs. And you can look, for example, and you can just look at the company logos. The green one is NVIDIA. The four square is Microsoft, and then Apple and Amazon. You can see that if you invest in, a lot of these, there's a pretty significant exposure to some of these tech companies, right? NVIDIA, Microsoft, Apple, et cetera. And so it's important to understand that it's not about just adding more and more funds and thinking that that's more diversified. You actually want to look and understand what the overlap is between some of the ETFs that you're investing in. So for example, VOO and VTI, different names, but they actually have almost identical holdings. So if you're buying both, you're essentially doubling down on the same companies. And that's fine, but it's not diversifying you necessarily. So you need to kind of look and understand what is that overlap. There is a tool that you can actually use to generate that, and that's called ETF-RC. It's the Research Center, and you can go in and actually plug in two different ETFs, in this case, the ones we just talked about, and you can see that there is an overlap of over 88% in those. So I think that's a good source to kind of make sure that you are actually, creating a portfolio that is diversified and not necessarily doubling down where you don't want to double down. A few final things, and then we'll kind of pause. My general guidance is don't try to time the market. It can really backfire. This is over a 20-year time frame, the annualized performance, if you were fully invested in the market, 6%. And then if you started missing out on some of the best trading days, and you can see that over 20 years, if you missed the 20 best trading days, you would already be in negative territory for that 20-year time frame. It is very, very hard to know when to kind of buy and sell. You can look at the top increases in the market, and single day increases in the NASDAQ. 16 of the top 20 came during a bear market. It is extremely hard to know when that pivot is going to be. And some of the biggest increases happen during a falling market. If you try to time it, you're often going to miss out on those and miss out on a lot of that upside. In short, be boring, stay in the market. The more time you can actually just stay in there and not try to, time it, the better off you will be. I'm going to jump ahead a little bit just to kind of end on this, which is ideally set up a solid plan, low cost index funds or ETFs, base it on a risk on your time horizon, rebalance, and to the extent you can, doing nothing is often one of the best things that you can do. One of the portfolios that I showed you before was from Burton Malkiel, who wrote one of the most famous investing books. It's called A Random Walk Down Wall Street. He gave an interview in the New York Times a couple of years ago. It was the 50th anniversary of this book. And one of the quotes there, which I loved, that he said is, "It is not often in life that the easy thing to do is the smart thing to do. The easy thing is to be average, be boring. And in this case, it's actually the smart thing to do." I'm gonna jump. There we go. Okay. If this has piqued your interest, there are a lot of different resources depending on your favorite medium of consumption, books, podcasts, columnists, etc. Um, if you are interested in deep diving on this, I was mentioning to Ty before, Professor John Campbell actually helped when we started this course about 15 years ago. He now has a personal finance course at Harvard for credit. You can feel free to sign up for that. It'll go into a lot more depth. In terms of financial advisors, the biggest recommendation I have is to only work with fiduciaries, which basically means that they are obligated to put your interests above anybody else. There are some resources at the bottom, but this is a great time, and I can turn over maybe to Ty or directly to Dennis to introduce Dennis. Ty mentioned at the start that the credit union has its own financial advisor. That's Dennis. And Ty or Dennis, I'll kick it over to you for a minute before we end, just
All
to kind of say
right.
hi.
Thank you so much, Shahar. I'm going to introduce Dennis here and then have just Dennis come on to. Actually, Dennis, you're here. Why don't you introduce yourself?
Hi, I'm Dennis Sexton. I'm the financial advisor at the Harvard Federal Credit Union. That's me with a suit on, like Shahar. This is me at home taking care of my hyper golden doodle. My wife is sick today, and our doodle needs 4 walks and food and all kinds of stuff. So I'm on the domestic front today. And my best advice is do what Shahar just said. If you do that, you'll never have to meet with me. I spend most of my days unwinding mistakes for people between 50 and 67 years old that didn't have the guidance that you've just received in education. And Shahar, I'm sure you see your share of that as well.
Yes.
Yep. And so, kind of follow what he's saying. If you end up working for the university, their retirement plan kind of automatically points you in the exact direction that Shahar was just outlining, using very low cost Vanguard funds, even lower cost within the Harvard retirement plan, and covering the total stock market index, domestic, international, and then same on the bond side. The results in that have been very good. So, my best advice, take your risk inside your retirement plan. Um, you're probably not going to be ready to invest after tax money outside the retirement plan until you pay down some debt, maybe buy a house, do some things like that. So I think for the vast majority of you, follow Shahar's education, and my type of advice will be further down the road for you.
Sounds great. Thank you, Dennis. And as we mentioned, Dennis is our very own financial advisor here at Harvard Federal Credit Union. So if you'd like, you can set up an appointment with him. He brings over 30 years of experience in the financial services industry, most recently with TIAA, and he helps our members with retirement building and all that stuff. So if you want next steps and you want to know the next thing to do, feel free to set up an appointment with Dennis. But thank you all so much for coming here today. Thank you, everyone. Thank you, Shahar. Thank you, Dennis. I'm not sure we have any outstanding questions. Let me just see. We have one here. It says, can any Harvard FCU customer speak with Dennis? What are the fees associated with that?
Yeah, there are no fees. We do act in a fiduciary capacity. And don't get me wrong, I'll be glad to meet with anyone that wants to. I'm just saying I'm probably going to point you in the direction that Shahar has outlined. The type of funds he's recommending are perfect for accumulation. And, there are exceptions. You may have already started your own business. You may have inherited money. You may be in a different category than some of the folks on the call. And you may need my advice at this point. But if anyone wants to set up an appointment, you can do that online very easily. Just go to I want to invest, and then below that, you'll see schedule a consultation and be glad to do it. And, we can connect. I can either point you in the right direction, which is likely in Shahar's direction that he's outlined, or if you do need the type of advice that I provide at this moment in time, we can set up another meeting and talk further.
Yeah, great. All right. Well, thank you everyone so much for coming today. Like I said, we're going to get a follow-up email with the link to the YouTube recording of this. You can always follow back up and check it out again, as well as a survey. We send out a survey because we're always looking for feedback. We read all of our results, so please let us know how we did. And thank you all again so much for coming here today. We ended right on time, so perfect time, gentlemen. Thank you again. And I hope you guys have a good rest of your week and a nice weekend. Stay warm and safe out there with the snow and the weather that's coming to Boston.
Right. Thanks, Ty.
All right. Bye,
Thank you.
everyone. Thank you.